Welcome to the Accounting Desk. In today's video, we're diving into IPSAS 4, the effects of changes in foreign exchange rates. This standard is vital for public sector entities that engage in transactions in foreign currencies or operate across borders. We'll break it down with practical examples, clear definitions, and visual explanations. IPSAS 4 deals with how to account for foreign currency transactions and translate financial statements into a presentation currency. It's based on IAS 21 and is applicable to all public sector entities using accrual accounting. Key objectives of IPSAS 4: specify functional and presentation currency, determine how to record foreign currency transactions, deal with exchange differences, guide translation of foreign operations. Let's look at some important definitions you need to know. Functional currency, the currency of the primary economic environment in which the entity operates. Presentation currency, the currency in which financial statements are presented. Foreign currency, a currency other than the functional currency. Exchange rate, the ratio for exchange of one currency for another. Monetary items, units of currency held and assets liabilities to be received, paid in fixed or determinable amounts of money. Understanding these is essential to apply IPSAS 4 correctly. How do you determine your functional currency? It depends on several factors. Currency that mainly influences sales prices. Currency of the country whose competitive forces and regulations affect pricing. Currency influencing labor, material, and other costs. For government entities, it may also depend on where funding is received and expenses are incurred. When a foreign currency transaction occurs, it must be recorded at the spot exchange rate on the date of the transaction. Example: an entity buys equipment USD 10,000 when 1 USD equals 150 PKR. Initial recognition, PKR 1,500,000. This amount stays fixed unless it's a monetary item subject to remeasurement. After initial recognition, monetary items like receivables, loans, are retranslated using the closing rate at the reporting date. Non-monetary items measured at historical cost are not retranslated. Non-monetary items measured at fair value are translated using the rate on the date the fair value is determined. Exchange differences arising from retranslation go to surplus or deficit, unless they relate to a foreign operation. If an entity presents its financial statements in a currency different from its functional currency, these steps are followed. 1. Assets and liabilities, translated at the closing rate. 2. Income and expenses, translated at transaction date rate or average rate. 3. Exchange differences, recognized in a separate component of net assets equity, translation reserve. This is especially important for consolidated statements of foreign operations. When a foreign operation is disposed of, any accumulated translation reserve related to that operation must be recycled to surplus or deficit in the period of disposal. This ensures the full impact of the foreign operation's results is reflected. Let's look at two practical examples. Example 1. Loan in foreign currency. Loan of USD 5,000 taken when 1 USD equals 100. At year-end, rate is 110. Initial recognition, 500,000 year-end valuation, 550,000. Exchange loss of 50,000 to be reported in surplus or deficit. Example 2. Foreign operation translation. Subsidiary's functional currency is UR, but parent presents in GBP. Assets liabilities translated at closing rate. Revenues expenses at average rate. Difference goes to translation reserve. IPSAS 4 requires detailed disclosures, including functional and presentation currencies, reasons for using a different presentation currency, amounts of exchange differences in surplus or deficit, reconciliation of translation reserve, description of changes in functional currency, if any. This ensures clarity for users of financial statements. To sum up, identify your functional currency based on economic environment. Record transactions at spot rate on transaction date. Remeasure monetary items at closing rate. Translate financial statements of foreign operations systematically. Disclose all currency-related impacts transparently. IPSAS 4 ensures that exchange rate changes are accounted for consistently, providing a clear view of an entity's financial position and performance across borders. If you found this helpful, hit like, subscribe to the Accounting Desk, and turn on notifications. Have questions? Drop them in the comments. We respond to every query.